Charlie Munger, vice chairman of Berkshire Hathaway, is perhaps best known for his longtime association with renowned billionaire Warren Buffett. But did you know that Munger's extraordinary financial success came about, in part because of his upside-down investment philosophy? In the dynamic world of finance, where markets fluctuate and economic landscapes evolve continually, learning from seasoned pros can be a game changer. Before we dive in, make sure to hit the subscribe button to join my financially curious community. Today we'll consider the investment wisdom of Charlie Munger, whose astonishing financial success is a testament to the value of his insights and the soundness of his distinctive investment philosophy. Charlie Munger is a staunch advocate of multidisciplinary thinking, which involves drawing insights from various fields beyond finance. Understanding human behavior is crucial in predicting market movements. Munger's insights from psychology have been instrumental in assessing market sentiment and making rational investment decisions. To evaluate business fundamentals, Munger emphasizes the importance of understanding microeconomics. This discipline helps him assess a company's competitive advantage and long-term viability. Learning from historical patterns is a Munger hallmark. His historical insights aid in recognizing economic cycles and understanding how events from the past can shape the future. Munger's fascination with science, particularly biology and chemistry, contributes to his analytical approach. He often compares investment situations to scientific problem-solving. Munger's proficiency in statistics and mathematics aids in quantitative analysis and guides his investment decisions. Let's explore some specific investments where Munger's multidisciplinary thinking played a pivotal role. Recognizing the powerful emotional connection people have with brands, Munger's understanding of psychology enabled him to see the enduring appeal of Coca-Cola's products. Munger's investment in Wells Fargo, a bank with a strong reputation and history of prudent lending, was informed by his decision to study banking through the lenses of psychology and history. Microeconomic insights were at play when Berkshire Hathaway acquired See's Candies. Understanding the importance of a strong brand and pricing power, Munger recognized the value in a business that could maintain premium pricing. Munger's familiarity with engineering and science informed his decision to invest in Precision Castparts, a company in the aerospace industry. His multidisciplinary thinking allowed him to assess the technical aspects of the business. Patience and rationality, particularly waiting for the right opportunities and avoiding impulsive decision-making, are pillars of Munger's investment philosophy. Nothing encapsulates Munger's philosophy on patience better than his comment, "The big money is not in the buying and selling, but in the waiting." Munger speaks often about the virtue of waiting patiently for the right opportunities. He believes that success in finance is not just about making quick decisions, but about waiting for situations where the odds are overwhelmingly in your favor. Munger's philosophy aligns with the idea that true success is achieved over the long term. By patiently waiting for the right moment, he was able to capitalize on opportunities that unfolded over time. Munger stresses the importance of rationality over emotion, advising against making decisions driven by short-term market movements. One of Munger's key teachings is the avoidance of impulsive decision-making, especially during market fluctuations. Munger recognizes the influence of cognitive biases in decision-making. By being aware of these biases and actively working to overcome them, investors can make more rational and considered choices. In the early 60s, American Express faced a scandal that significantly impacted its stock price. Munger saw through the temporary setback, patiently waiting for the market to recognize the company's enduring strengths. The investment turned out to be highly successful over the long term. Munger's assessment of the long-term potential of the Washington Post Company resulted in a highly profitable investment. Despite short-term market fluctuations, he maintained a patient and rational perspective. Perhaps the most significant example of patience and rationality in action is Berkshire Hathaway itself. Munger and Buffett patiently built the conglomerate over decades, making rational decisions about acquisitions and investments. The result is a company that has become a symbol of enduring success. One of the most common mistakes Munger mentions is overconfidence. Investors may become overly sure of their predictions, leading to risky decisions based on inadequate research and a failure to consider potential downsides. While quantitative analysis is valuable, Munger emphasizes the importance of understanding qualitative factors and cautions against excessive reliance on mathematical models and formulas for investment decisions. Munger often highlights the failure to learn from history as a significant mistake. Investors may repeat the errors of the past by not studying and understanding lessons from previous market cycles and economic downturns. Another pitfall is the failure to adapt to changing circumstances. Munger stresses the importance of being flexible and adjusting one's investment strategy in response to evolving market conditions and economic landscapes. Herding behavior, where investors make decisions based on the actions of others, can lead to suboptimal outcomes, and Munger warns against blindly following the crowd. Investing is not without its pitfalls, and Munger has keen insights on strategies to avoid the most common investment mistakes. To combat overconfidence, cultivate humility, acknowledging that the future is uncertain and unpredictable. Munger is a strong advocate for continuous learning and would advise staying informed of shifting markets and economic trends. Munger encourages investors to question prevailing wisdom and to be cautious when everyone else seems overly optimistic. Be willing to think independently and be a contrarian when necessary. Munger emphasizes the importance of taking a long-term perspective in investing. Avoid being swayed by short-term market fluctuations and focus on the underlying fundamentals of your target investments. Not one to mince words, Munger's insights reflect a unique perspective on wealth creation. Even his most controversial piece of investment wisdom is worth a deeper look. Munger's mantra, invert, always invert, is more than just a catchy phrase. It's a way to challenge conventional thinking. An offhand comment epitomizes his inverted approach. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. The idea of inversion is rooted in the concept of thinking backward. Rather than focusing solely on positive possibilities, Munger recommends considering potential pitfalls and obstacles. By identifying what can go wrong, investors can make more informed decisions. Applying inversion to investing means considering not just potential gains, but also risks and downsides. Instead of asking, "How can I make money in the market?" ask, "How can I avoid losing money?" Given that success in the market is not just about making the right moves, but avoiding the wrong ones, Munger's inversion approach may be useful for challenging the optimism bias and herd mentality that can derail investment decisions. Munger uses his experience with Coca-Cola to illustrate the inversion principle. Instead of focusing solely on what would make Coca-Cola a successful investment, he thought about what could make it fail. By addressing potential risks, his evaluation was more comprehensive. Munger's invert, always invert philosophy has faced criticism for being overly cautious or pessimistic. Some argue that focusing too much on potential failures may hinder the pursuit of opportunities. But Munger sees it as a pragmatic way to avoid costly mistakes. Given Munger's proven track record and history of weathering financial storms, his timeless wisdom should be given due regard. By employing multidisciplinary thinking, cultivating patience, and thinking backward, you can leverage Munger's insights to build a resilient and informed approach to investing. Congratulations on taking time to improve your financial health by learning about Charlie Munger's distinctive investment philosophy.